Hello and welcome to this session. This panel discussion is on Southeast Asian startups' readiness to take on the global stage as they tap growth and exit avenues. I'm Deepshikha Monga, an editor at DealStreetAsia, and today with me are two prolific investors in this region, Abheek Anand, Managing Director, Sequoia, India, and David Gowdey, Managing Partner at Jungle Ventures. Welcome, Abheek and David.
Thanks.
Thank you.
Okay, let's dive straight into the discussion. How much of a role have Sea Limited's meteoric stock rise and Grab's impending SPAC merger played in bringing the global spotlight to Southeast Asia startups? David, do you want to take that first?
Yeah, do you want me to start? I don't think it can be underestimated. I think, if you think about SCA, if they were a US-based company, they would make it in the top 20 list of all companies in the US, tech companies in the US by market cap. And so at 175 billion, it's just an enormous business today. And I think that's really helped, bring awareness of the Southeast Asia region, particularly to US-based investors. I think the upcoming IPOs of Grab, you look at Bukalapak and the success that they've had, I think it's only increasing the awareness that people have of the region. And so if I think about, some of the conversations that we have with our investors, 5 years ago, we would have spent a great deal of time talking about Southeast Asia, educating them about the dynamics of the region, where now I think most people will move past that quite quickly. I think they have a pretty good understanding of what's happening here, and it becomes much more, a different kind of conversation. And so I think the IPOs of those companies have just continued to advance that.
Abheek?
Yeah, I completely agree with what David just said. I think just to add to that, the fact that tech companies in Southeast Asia were going to go public was a matter of when and not if. And depending on how close you were in the market, it's just a question of the vintage of startups maturing and getting to the stage where they are ready to go public. I think there's a few things that have particularly stood out. One, like David pointed out, these IPOs highlight the depth of our market, which, if you're not an insider on the outside in, it might appear to be, less clear. Of course, a lot of us who are sitting on the inside see that happening on the ground, but it is important validation for people seeing it from different markets. I think the second thing that's also going to happen is just many of these companies are going to become breeding grounds for startups of the future. And we're already starting to see that, founders coming out of many of these large tech companies saying, hey, we've seen the journey to go from, a $0 to a $10 billion company. In some cases, like the case of Sea, a $175 billion company. What can I do next? And these are people who've been trained as startup operators. These are people who, frankly have now significantly more ambitions than they might have if they'd started 5 years ago. So the talent market is seeing a pretty rapid set of maturation as well as a result of these companies going public. And I think the other thing that's also starting to happen is a lot of the regulatory, landscape is being cleared out as some of these companies start to go public. Whether it's, the IDX starting to be a hub for tech companies starting to go public, whether it's bankers starting to spend more time looking at maturing companies, growth stage investors realizing that there is a bunch of companies that are at the cusp of liquidity and pre-IPO rounds getting contemplated or happening. There is this sort of pretty rapid growth in the latterest part of a company's life as far as sort of regulation and the investment climate is concerned. So look, I think net it's been huge, but I would say it's just the beginning. The next 5 years are going to bring many more such stories.
Sure. But these companies are outliers. Sea is a truly global company. Grab and GoTo are of massive size. These events, their IPOs, how much of an impact do these have on other startups across the region? And Abheek, you touched upon it previously. Could you expand on that, especially if you talk about smaller companies that are in the region?
Yeah, look, I actually don't know if I agree necessarily with the comment that, hey, these are outliers. I would say, tech startup outcomes often seem, pretty improbable in foresight and pretty obvious in hindsight, right? If you look at, for example, the way startups have, valuations have surged, both private and public markets over the last 10 years, There was a point not too long ago, I would argue 5 years ago, where $100 billion company was a massive outlier. You could I couldn't think of a single company that was, starting to inch to that scale. At that time, probably the only startups that were starting to get to that level were, Ant in the US, and that was pretty much it. Today, if you think about it, I would say like last year, we had several companies go public at over 100 billion of market cap. Today, there are multiple companies, several in Sequoia's global portfolio that are north of 100 billion of market cap. So I do think in some ways, 10 billion is the new 1 billion and 100 billion is the new 10 billion. So there is this sort of moving goalpost, if you will, on both ambition and scale of markets, because markets are also expanding, a lot more rapidly. And again, it's this whole idea of compounding of market sizes, right? Where things were 5 years ago is very different from where things will be 5 years from today. So I do think that the bar has just been raised for all other founders and investors out there in terms of what is possible in Southeast Asia's markets. And, look, there is this idea of talent. There is this idea of this thought around capital coming in, but also, now we have potential acquirers in this market. Now we have potential market partners. We have distribution platforms that are getting, to scale, that are going to be the breeding grounds of the next set of companies. So again, when this cycle starts to really spin, it sort of only spins faster and faster. And again, I think we're at the very early days of that happening over here.
Yeah, I would agree with that. I wouldn't think of these as outliers. I would think of them as being the first cohort of companies to achieve this kind of outcome. But I agree. I think there are multiple kind of cohorts coming through, and it's a function of the time that it takes to create a business of that level of scale. If you think about their impact on the broader ecosystem, I think you can think about kind of three, big kind of drivers. One is what Abheek just mentioned. I think there'll be an increasing level of M&A. So as you think about, technology companies, C is a great example. They're probably expanding and moving to adjacencies more in international markets. But I think there will be several of these players who will be expanding, either into new geographic areas, new areas of operation. A lot of times it's faster and easier to do that through acquisition rather than organically build out. And so I would expect that as these companies go public with the balance sheets that they have and the security that they have to trade, that M&A will probably increase. I think the second thing is that as you get these level of capitalization in these companies, they will inevitably be looking for software providers, HRM systems. They are becoming a key client for many startups in the region. And so as startups think about selling their services into companies, these larger companies will be taking up a lot of those services. And then the last point is that if you think about most developing tech ecosystems around the world, the thing that liquidity tends to provide is a lot of seed capitalization. And so as you have executives that have their companies go public, if you think about Grab executives or C executives or Bukalapak executives, as they get liquidity off of their stock options or their equity, to funnel some of that back into the ecosystem through seed investments, through investing in teams that are spinning off, to creating new companies. And I think you'll see a lot more of that capitalization come at the early stages and evolve in a similar way to how China and the US evolved.
While you may both agree that these companies are not outliers, they still have a fairly sizable presence. What if you're a startup without a regional presence? Is it not enough for a startup to be focused on one market, especially if that market is not Indonesia? So from an investor point of view, what advice do you give your companies, the companies in your portfolio, on their expansion? Anyone, if you can take that first.
Go for it.
Yeah, so I think the answer is it depends. Certainly there are large businesses. VNG in Vietnam is a great example of companies that have built very large businesses off of a single market, which is not India or Indonesia. I think clearly, given the population size, India and Indonesia are very large markets. I would think that most companies in Southeast Asia are probably tending to think about regionalizing their businesses, but it really depends on the business itself and whether or not the problem set that they're solving in their first market exists in other markets and that they can solve it in a very similar way. And that is broadly, defined by whose problem they're solving, what the market looks like, how big the addressable market is, whether there's a regulatory overhang for the business that would prevent them from moving into different markets or make it a little bit more challenging. And so I think the answer really is it depends. But obviously, to reach the largest addressable market, you would want to be across the entire region.
Yeah, I again agree with David's points. I think I'll add a couple more things. Pretty much every company constantly is thinking about expanding TAM. It could be a young startup that's in year 2, year 3 of operations. It could be a Google that decides to get into, decides to buy Android or Instagram, gets acquired by Facebook. I mean, these are all big companies expanding the addressable opportunity that is in front of them. So good founders are constantly thinking about expanding TAM. We had one of our portfolio companies go public just last week on the NASDAQ. Freshworks, they started off as a very point solution in the CRM space, and now have multiple product lines that are again expanding TAM. It's not necessarily new geographic markets that they're going into, but it's new product markets that they've been expanding into. The other thing that we're starting to see is, again, just an increased level of ambition and creativity in very early stage founders in Southeast Asia. I would argue, these days, a good majority, maybe north of 50% of the companies that we are intersecting with and partnering with either have imminent plans to expand or are already regional. So I'll give you one example of a company that we partnered with last year in a Series A, which is a edtech company called Lingoways. This is a company where the founder is based out of Singapore, but he's of Chinese origin, so he built out a massive product and engineering team in Beijing, and his customers are all global, with most of his business in North America. So again, founders are realizing that they have to go where the customers are and where the engineers are, and geographic boundaries tend to mean a lot less. Now, of course, there are some markets and categories where that's a little bit harder. For example, regulated markets where you have to play it, geo by geo and understand and navigate regulation accordingly. But even for those guys, I mean, if you think about the way C has played out their financial services business, it might be country by country, but it's multiple product lines that are in the works simultaneously. So again, this idea of expanding the addressable market is a constant thing at the back of most founders' minds.
What value add then as VCs do you provide in helping your startups expand and think about expansion, whether it is geographical or in terms of the verticals they are in? Abheek, could you take that first?
Sure. And look, I think especially in today's world, capital is a commodity, right? I mean, there is just so many new investors, whether it's at the seed stage, solo, capitalists, entrepreneurs, VCs, angels, growth funds, crossover funds, public market funds. There is just, tons and tons of ways for folks to raise capital. Our focus at Sequoia is very squarely from day one been on company building. So, we have north of 40 people in our office right now in Singapore. The majority of them are actually not in the investment team, they're in the portfolio specialists team. And so these people are actually not investing and finding new companies to partner with, but these are folks who are working with our portfolio companies trying to make them successful. I'll give you 2 specific examples of that. Just last year, we added Ajay Gore to our team. He was the group CTO at Gojek, and he left Gojek to come back and join us at Sequoia. He's an operating partner in technology, and he spends all his time with early stage companies, helping them understand tech and product roadmap. Because we believe that the gap in engineering and product in talent in Southeast Asia is slowly being bridged, but is not at the level where it needs to be. So we are adding people to our team who can go in and really sort of work very, very closely with these founders and coming up with very detailed product and tech roadmaps. Another example is a team that we have in-house called the Strategic Development Team, which is really helping our portfolio companies with everything from capital raises to acquiring other companies to going public. So just this week, we had a company in Sweden that went public. One of our portfolio team specialists was actually on the ground, basically being their corp dev head and running their entire IPO process for them. And that has happened in many, many different ways. Just last month, we had an event in a virtual event called Pit Stop, where we had dozens of our portfolio companies meet over 85 investors, growth investors globally, and share their story over a course of 4 days. So hundreds of meetings being set up for our portfolio companies to go out and raise the next growth round. these are all, activities that, frankly, take up the vast majority of energy inside of the building for us. Investment is really, just step one. And I would argue that sort of the easier thing. Company building over many, many years is much harder. And that's what we spend most of our time on.
David, how's Jungle doing it?
Yeah, in a very similar way. I think there are kind of large areas where you tend to try and add a lot of value. It really depends on the business, but hiring is going to be a key function. Go to market, customer acquisition, whether it's on the enterprise side, B2B type businesses or B2C businesses. But I think the other thing too, where we spend a lot of time with our founders, is just on the expansion strategy. And so I think you really want to get the timing of that right and make sure that you're not pushing into new geographies or new spaces before you've kind of locked down the core business. And so, really understanding your own unit economics, having a secured kind of footprint in your core market, and then, using that as a base to then expand. A good example of that is we have an operating partner who's based in Boston. He works with all of our software companies. So for software companies that are going to go global, they tend to re-domicile to the US, or they'll set up their go-to-market operations in the US. And it's a great kind of footprint to have a Southeast Asia-based cost base with a US dollar go-to-market revenue base in the US. But there's a lot of challenges entering the US market, and so he's really there to help them as a landing pad to get them set up operations, get the team on the ground, and get the go-to-market in the US working. And so there's a lot of learnings that you can leverage from one company to another company, particularly if you're staying thematically.
Sure. Let's talk about exits. Exits have traditionally been the biggest hurdle in fund managers being able to deliver returns to their LPs in this region, and that translates into the attractiveness of the startup ecosystem here. How much progress have we made as a region in that regard? David, you want to go first?
Yep, I'll go first. So, we've consistently been driving exits every year at Jungle. TradeGecko was acquired by Intuit. We've sold companies to the likes of Rakuten, to Twitter, to HomeAway, to iSelect, to Naspers. And so I think there has been a fair bit of M&A activity that's been happening in the region. I certainly think that there is an increase in that. As you think about foreign companies, whether they're in the US or China, looking to enter this part of the world and establish a footprint, a lot of that will be through acquisitions, like we talked about earlier with Grab and some of the other large players. I would expect them to also increase their level of acquisitions. But then to the point that was probably made on the panel before ours, is that I also think that the public markets are starting to become quite interesting, where you do see companies lining up to go public in Indonesia and Thailand and some of the local exchanges. We have one company that is listing in Tokyo, for example. I think there's been some success on the ASX, and then obviously for the companies that are getting a larger level of scale, there's NASDAQ and the New York Stock Exchange.
Sure. Abheek, I would want you to answer that, but also since David mentioned TradeGecko and Intuit, we talk about global acquirers buying companies in Southeast Asia. When do you see the reverse happening, where companies in Southeast Asia or perhaps India acquire their peers in the US and then leverage their domestic or regional capabilities, especially on the tech side? When do you see that happening?
Yeah, look, I think that's a matter of scale, and that's already starting to happen. And I can definitely share examples from our portfolio of companies that have acquired companies in other more developed markets. But our belief at Sequoia is that the thing to aim for is a public listing. If you do the analysis, and we've done that math on overall returns generated across the VC asset class, pretty much in every market, the vast majority of returns come from public listings and not from M&A. And we always think about, for example, the big M&As that have happened historically, whether that's Instagram being acquired, or like WhatsApp being acquired, or LinkedIn after going public being acquired, but those get dwarfed by the size of companies that actually end up going public. Just in the last 18 months, we've had multiple companies globally go public, which are, north of 50 billion of market cap. And, at least I struggle to think of any acquisition that's happened at that scale. So at least our belief is that, M&A is healthy in that it, it sort of helps keep momentum of exits going in the region. And it also is a sign of a maturing ecosystem, but real returns come from public listings. And, our focus is absolutely trying to help our portfolio companies go public. Just this year, we've had, I think about 7 companies go public in this calendar year already, and we have many more coming up. And I think it's a sign of a few things. One, markets in most developing areas, especially in Asia, are starting to mature, where again, we have a vintage of companies that are now starting to go to scale. Second, public market investors being much more sort of growth and tech focused, and public market funds looking at these types of companies much more closely. Third, exchanges becoming a lot more interested in expanding the number of public listed tech companies on their platforms, because that's where most of the growth is coming from. I think if you do if you do sort of the analysis of, for example, the top companies by market cap on NYSE in 2001 versus 2021, I would say that you'd probably find not more than 1 or 2 companies that actually are still there, and they've all been replaced by a set of tech companies that have mostly gone public in the last 10 to 15 years. So again, I think public markets is what we should sort of set our North Star at. That's what we spend most of our time focusing on, and we also encourage our founders to think about listing as the outcome in terms of sort of an exit.
David, what's Jungle's advice to its companies on exit avenues? IPOs over trade sales?
Yeah, I think it really comes down to the business. I think there are certainly some businesses that will create a positive IPO story. I think there's other businesses where the public markets, may not understand the nuances of the business to be able to price it effectively. So there are certainly businesses that are in our portfolio that are on path to IPO. I think we also don't necessarily view the IPO in it of itself as an exit. It's a funding round that has the added benefit of liquidity, if you think about it that way. And so I think you need to time the cycle right. I think you have to think about the right exchange, where you're going to get the right level of liquidity, and you can bring benefits back to the business that are greater than raising a private round. But we also have businesses in our portfolio that we certainly think will continue to build over a longer period of time. And so there are multiple ways for venture capitalists to get exits, whether it's through secondary sales, through the cap table, where the founder doesn't need to sell the business, he doesn't have to get an IPO, but we can still get the returns that we're looking for. And so that's really about constructing the right type of cap table and making sure that there's downstream capital that's coming into those businesses. And so I think we probably think pretty broadly about our path to liquidity and work with our founders on what's the best kind of path for them and for their particular business.
Abheek, you mentioned Freshworks. How significant was that IPO for the ecosystem in this region, especially for B2B and SaaS companies?
Yeah, look, I think, I would say, especially in Southeast Asia, historically, B2B and SaaS has not been an area that a lot of founders sort of think about when they want to start up. And I think role models of companies that get to scale and go public always help, whether it's, companies like Freshworks that go public at a very significant scale, whether that's companies in our region like Zendit that are raising at significant scales of private valuations. I do think that these, tend to sort of be companies that really demonstrate to founders that there is a path to building a pretty valuable business in B2B SaaS. One of our first investments in Southeast Asia was a company called Appier, which went public this year. Again, B2B SaaS company building an enterprise AI stack. So I do think that these types of businesses are important because B2C typically tends to get the limelight, but that's just a function of where in some ways the local market is, because it's a very consumer-driven market. What we are starting to see now is very interesting SaaS models emerge that are either going regional or global from day one, or figuring out ways to address more local businesses in a manner that is actually a lot more scalable. We've seen a lot of companies building MSME SaaS businesses that are all sort of Southeast Asia regional businesses. And these are getting to some pretty nice scale as well. So at least in the very early stages right now, at the seed and Series A stage where we are the most active, we are seeing a pretty significant shift in Southeast Asia in terms of starting to see a lot more B2B SaaS opportunities than we were maybe 5 years ago.
David, you mentioned secondaries as an opportunity for exits as well. How is that market coming up?
Well, I think, for high growth businesses, there's certainly a lot of appetite downstream. And, whether that is primary, whether that's secondary, I think if it's a high quality business, then I think there's always going to be appetite to buy into that business. If you think about Grab and Gojek and, a lot of the private companies, large private companies, it has a very active kind of secondary market. Where in every primary round, there's also a secondary component where people, the company didn't want to take the additional dilution, but did want to bring some people onto the cap table. And so, secondary is a great means to do that. So.
Sure. Let's take an audience question. When it comes to going global, is CGroup the best case study for this region? They have a global business. They've expanded to Latin America. And they're expanding their offerings as well. Is that the best case study then for SEA startups, Southeast Asian startups going global?
Well, it certainly would be the largest in Southeast Asia. But, if you think about more broadly, whether it's Baiju's in India or, I think software is the category that tends to have more, global from day one type building prospects. We have a company in our portfolio, Salt9, which was founded here. The entire go-to-market, it's a global business, getting the largest traction in the US, but started and founded from here, really global from day one. But I do think, the great thing about Freshworks and a great thing about C and some of these businesses is that they can be very transformative for a region. So if you think about Atlassian going public, it really changed the landscape in Australia, and founders could see that they could build a globally scalable business from Australia. And so I think the more businesses that we have in India and Southeast Asia, the more confidence it builds in founders to say actually can build, a very large global business out of this part of the world. And so I think that is, I think that's just a great result for the whole ecosystem.
Sure. Abheek, do you want to add?
No, I think I agree with what David is saying. I think CGroup is a great example of. I wouldn't sort of use them necessarily as an example of a company that has already accrued a lot of value from going global. Most of their value right now is still from the Shopee business, which is more regional. I think what they are an exemplary example of a founder who is just incredibly tenacious and ambitious. And, I think if you were to ask anybody, most people a few years ago, how the trajectory of the business would be, I would say like very, very few people would predict how well these guys would execute. So I think they've just, more so than pretty much any other company in the region, just demonstrated that when you have an incredibly ambitious founder combined with, a fantastic team, there is a massive market opportunity to go after, whether that's regional or global. So I do think, our advice to founders is always, hey, don't artificially constrain yourself to the market that you're in. It's comforting to be the largest, fish in a small pond, but really the way to excel and set yourselves up to a higher standard is to expand the size of the opportunity that you're going after constantly.
Sure. Let's take another audience question. In many cases, tech exits are seen as bringing paper profits and real value to investors. What's your stand, and how long can investors, especially later stage investors, tolerate loss-making businesses?
I'm happy to take that. Yeah, I'm happy to take that. I think that question is a question that a lot of people ask, but I think the question obscures the facts of what investors are looking at when they see businesses. Public market investors are not necessarily viewing companies as, hey, there has to be profitability for us to invest. They are looking at companies that are building fundamentally healthy businesses with significant growth rates in massive markets. I think if I was, a public market investor, I would view those three things as far more significant than near-term profitability. I'll give you an example. Snowflake is a company that is, almost $100 billion of market cap, one of the largest SaaS companies in the world. It's not profitable. And the reason it's being valued as highly as it is, despite not being profitable, is it's building an amazing product in a massive, massive market. And that product has terrific unit economics. And so if you have growth rates and if you have unit economics, the question is, why not invest in a company where you have conviction that at some point they will get to profitability? So I think we should distinguish between companies that have fundamentally healthy businesses and proven unit economics versus businesses that do not have proven unit economics where you're still taking that risk. Now, I would argue that as investors, it is okay to take that risk because you also get rewarded for it. Right? I mean, if you want zero risk, you could go invest in US Treasury bonds. Although, as of last week, maybe that's not the least risky asset class in the world, but you could do that, right? And you would get whatever yield you would get, potentially negative yields. You could go invest in bonds in Europe and in Japan and get the yields that come with that and the security that comes with that. But investors are looking for companies that are going to build massive, massive businesses. Now, if you did not invest in one of these companies 5 years ago, I think your returns from pretty much every other company that you could possibly have invested in would get dwarfed by these outcomes. So again, profitability I would argue is important, but it sort of sometimes seems to obscure a more nuanced point of view, which I think is important to really truly be an excellent investor.
David, do you want to add?
No, I mean, I agree with all that. I think one of the challenges of our industry is that, we suffer from illiquidity and we think about our investment time horizons in terms of, 5 years, 8 years, 10 years. So you have very long cycle times. And so by nature, companies will continue to raise capital. We will continue to see what you call paper gains, where, the value of the equity that we hold continues to increase. And like Abheek said, valuation is a function of, your current value of the business, current value of cash flows of the business, as well as what you think the future prospect of that business is. And so particularly in this part of the world, I think there's just such an enormous level of growth yet to come. Recognizing that, we've had an enormous level of growth from 2015 to today. But if you think about, today going forward to 2030, there's still an enormous amount of growth that's in this region. And so that growth is obviously going to get priced into where a lot of these companies can go. But again, it comes back to, Abheek mentioned, it's the core kind of fundamentals and unit economics. And is this, company, do they have a right to win this space? How big is that space? And what's their ability to execute on that? And so I think that's what's going into valuations. And like we talked about earlier, there for local market investors, as you start to swap those out for the larger late stage investors coming into the region, or private equity coming into companies, then I think there are opportunities for the venture investors, the earlier investors in companies to exit the cap table, recognize some of the returns, and let that company continue to grow. So,
David,
but I think it's where we are in our ecosystem as well.
Yeah, I mean, if I actually add to that, and again, agree with everything that David is saying, because we're all seeing exactly the same thing. I think the same argument also holds true when we hear commentary around private market valuations. And sometimes we get asked this question like, hey, why would you invest in a company at this price? Like, it makes no sense. And I think again that question masks the real question that needs to be asked. The real question is not, hey, would you invest in a company at 500 million valuation if it's only $1 million of revenue? I mean, of course, the revenue multiple looks crazy. Of course, that feels like a very expensive price. But if you have conviction that that's going to be a $10 billion company and market clearing price is 500, why would you not invest, right? And so I think this idea of pricing and profitability in a market that is high growth and in a market where we are all investing not for the market of today, but for the market of 10 years from now, is a bit of a red herring.
I was going to ask you if the valuations you think overall are frothy. Are you saying no?
No, I'm not saying no. Of course, the valuations are frothy, but like the valuations are frothy because those are market clearing valuations. And looking at point in time, looking at today's valuations is kind of like saying, like I'm going to go run the Olympics based on, like my pace at 100 meters today. That's not the case. Like, I mean, if I want to compete at the very highest level, I'm going to, maybe that's a bad analogy, but it's basically saying, hey, we would price things based on an exit that would happen today, right? So let's say you invested a company at like a very heavy price. Yeah, today, if there is a public market listing for that company, you will be at a loss. But we are not investing for today. We are investing for 10 years from now. And, all of us obviously would like for there to be more rationality at prices, but the reality is that's where the market is today. If there is so much liquidity in the market, which by the way, is a function of how well the tech asset class has performed, right? If you have investors who are sitting on such massive gains from such large IPOs, they would want to go out and continue to invest in this asset class, and therefore prices will move up. So what that does do is, in the long run, there is a compression of returns, which is sort of the headwind in the market. The tailwind in the market is that the market sizes are also constantly expanding. So what you might think is $1 billion outcome today, if you were to expand that 10 years from now, and if 10 years from now, the markets even compound at like, 15% a year, which is, really nothing for many tech markets, that's a 4x higher price, just based on market size expansion, right? So to me, like, I think this idea of, valuations being frothy is sort of missing the forest for the trees.
David, your views?
Yeah, no, I agree. I think a lot of people miss the nuance of the underlying market growth that drives performance of companies. If you think about the digital economy, our share of GDP in this part of the world, you're talking about as much as it's grown to date, it's still less than 4% share of GDP going into the digital economy. China is over a third is going into digital economy. And so there's an enormous headroom for growth. And if you think about, digital consumption has grown 3x, it will double again in the next 5 years. 70 million people have become new consumers through digital channels just during COVID. There's just a lot of underlying growth that's in the markets that are driving the businesses. And so if you kind of compare valuations on a historical basis and say, well, a company is, Series A in 2015 looked like this, and a Series B looked like this in 2015. I would argue that the Series A and Series B companies today are probably 2 or 3 times the level of scale that their counterparts were back, 5 years ago. And so I just think valuations are naturally going to increase. They're naturally going to value the growth is coming into the market and where the market is today. And so naturally valuations have to increase. If we have this discussion again in another 5 years, I think we'll be talking about how frothy valuations are then compared to what they are now. And so I think we're going to grow as the market grows, but there's an enormous amount of growth that's ahead of us.
All right. I'll take this final question from the audience. You've talked about IPOs and how Abheek specifically wanting your portfolio companies to aim for an IPO. How are exchanges in Southeast Asia placed to handle tech listings? And what do you make of the SGX's efforts to sort of boost the local bourse? Start with you, Abheek.
Sure. Look, I think there is a massive disconnect between where we need to be and where we are in terms of local exchanges. I know there's been a lot of initiatives in the past and to this day by both governments and private players to sort of get our exchanges ready. We are not there yet. And if I had sort of a magic wand or a wishing well that I could throw a few coins into and like get something like this would definitely be amongst the top of my wish list, which is I do think that it is infeasible for us to continue this level of growth and for exchanges to be where they are today. We are just leaving a lot of value on the table for our local economies. And so I do think that's a little bit outside of the purview of at least what we do. And it's much more of a regulatory and sort of maybe a government related question. But I do think getting that right is going to be absolutely critical. Look, people are going to go public regardless of what we do. It's a question of whether we can keep enough of the value over here and use that value to sort of increase, investor sort of in confidence in our markets, or is that going to just be, is the next C going to again list in New York, or is it going to list over here? If it, the next 5 Cs go listed in New York, that's a massive wasted opportunity.
David?
Yep, no, I agree. If you think about any, mature tech ecosystem in the world, whether it's, London, China, US, I think they all have a very strong public market supporting their businesses, where high growth businesses are valued appropriately by investors, and retail investors can invest in companies and brands that they know, they trust, they use. I think that the same is going to exist here. I think it's a huge opportunity. I think a lot of the exchanges are moving in the right direction, whether they're relaxing some of their policies, whether it be a profits test or pass to list. But I think it'll only increase as this cohort of companies gets larger and larger, and we'll start to think about public listing and think about what's the right exchange for them. And I hope by that point, when you have this large group kind of moving through over the next few years, that there is the right kind of exchange to let these companies go public and let local market investors, capitalize on their growth and invest behind them. And so I think it's a big opportunity, but certainly not.
All right. Thank you so much. That's all the time we have for this session. Thank you, Abheek and David, for all your insights. And thank you to the audience for joining us. Please stay on for the rest of the sessions today. Thank you.
Thank you very much.